The Fed released their meeting minutes for their previous FOMC meeting, and as expected, the market waited in anticipation and fear. What if they were making it seem like interest rates would increase? That would be disastrous. The market knows it's running on fumes at this point. It was made very clear in the transcript that the Fed would be very patient. However, if the economy starts to do well, interest rates could very well rise. You came here for the truth, so let me unveil that for you. Today we're going to look at what happened with the Federal Reserve. We're going to talk about how serious the implications of an interest rate hike really are. S&P 500 rises as majority of Fed sees no change in rates this year. Now they take this little snippet out, but they don't get into the entire thing, of course. This is what the market was looking for. They were simply looking at the fact that right now, as of today, there is no possible way that an interest rate hike will happen as long as the economy stays the way it is. They point to the same issues that we've heard before from Powell, from others, suggesting the fact that we've got problems because of Brexit, we've got problems because of China, we've got issues in Europe, and they're all piling up. This is what is the reason for the slowdown globally. Nothing to do with the United States, of course, but this is what they say. That's all I wanted to stress as part of this, but you'll see further along in this. The Federal Reserve released the minutes of its March monetary policy meeting with no change in rates expected this year. The U.S. Central Bank left the door open for more hikes if the economy improves. So you got this happening in big font up here. Don't worry about it. No change is going to happen. But the actual key point is right here. And that is, if the economy does improve, rate hikes will happen. I don't think that's going to actually occur, but that's what they say. So we'll go further into this. Let's take a look at this next one is directly from the actual minutes themselves. I wanted to show you this. A lot of people are not understanding exactly what it means for the Federal Reserve to have an interest rate at all. They don't simply type a number into a computer and that's where it's set at. They have to do what's known as open market operations. They get into that here in this paragraph and beyond, but I just wanted to touch on it because there is no understanding of this even in the financial realm. So take a look. Effective March 21st, 2019, the FOMC directs the desk to undertake open market operations as necessary to maintain the federal funds rate in a target range of 2.25% to 2.5%, including overnight reverse repurchase operations. There's more detail, and I don't want to get into all of it, but simply letting you know the fact that the Federal Reserve is not hiding what they do. They print money in order to maintain a select interest rate. That's what you need to know. That information is publicly available. It's not something that is hidden and it needs to be dug up and connected the dots. They make that known. But the general public, even those in the financial industry, they see the setting of an interest rate as simply something that is done very, very simply. There's a whole complicated process that's involved in that, and money printing is behind it. So you cannot set interest rates at a low level without creating an inflationary scenario in the long term. Printing money dilutes the value of all of that which is out there, and they are doing what all central banks are doing, and that is a race to the bottom. They are devaluing their currencies against real goods. You don't see it when you look at the Federal Reserve and what their actions have been, and then you look at the US dollar and think to yourself, hey, if I look at the US dollar and compare it to the euro, it's up. If I look at it compared to basically any other currency, it has done very well over the last while. But if you compare it to real goods, things start to look a lot different. What was the value 20 years ago? What was it 40 years ago, 60 years ago, and 100 years ago? And you start to realize that, okay, I got an idea of what they're planning on doing, and that is devaluing the currency. There is no doubt about that. Just some more quotes in here. Several participants noted that their views of the appropriate range for the federal funds rate could shift in either direction based on incoming data and other developments. Some participants indicated that if the economy evolved as they currently expected, so this is the expectation, with economic growth above its longer run trend rate, they would likely judge it appropriate to raise the target range for the federal funds rate modestly later this year. That's what they said. That is a quote. That's exactly what I'm talking about. And even a quarter point at this point will shake the markets. I'm not necessarily saying that it's going to create a crash, but the market doesn't like that at all. Now, the economy is weak. We see that globally, and it's taken place not because of some external factor that's happening in China or somewhere else. It's happening all over the world, and this has been piling up. There's been so many things that I will show you, some of which today have just been adding to all of the gloominess that's out there. So my expectation is that they will not increase rates. If you look at previous cycles, what happens? It stays at that level for a few months, and then they have to start dropping them rapidly. We'll see what happens this time around. Who knows? It's really all up in the air. The Federal Reserve's abrupt policy pivot has eased financial conditions and reduced the odds of a recession to just 10% over the next 4 quarters from 20% at the end of the 4th quarter. And guess who? Goldman Sachs. That's right. Goldman Sachs suggests that there is a 10% chance of recession. I would like to know what they were considering the chance of recession would be prior to all the chaos that occurred with Lehman Brothers with Bear Stearns. It would probably not surprise me to see it around the same number. I mean, you were looking at this back in the 4th quarter of 2018 when things were looking terrible, when the quantitative tightening policy was actually a thing, and then you saw this taking place at 20%. I just don't believe it. Anyway, I thought that was a little bit of humor for those who had that same kind of humor as I do. Let's take a look at this. China car slump persists with sales plunging for the 10th month. This is a problem that is going on all around the world, not just for cars, but we see this in many different markets. For decades, there was just one way for China's car market, up. Once the trend abruptly reversed 10 months ago, the free fall in the world's largest market has shown no signs of easing. This has been steadily increasing, getting worse, and all of the data, we have watched the housing market, we've watched the cars, we've watched the general economy falling, and all of this is happening at the same time. We have the central bank acting, they are intervening in the markets directly, we have the government itself making sure that money is being lent very, very easily, and the list goes on. There's no possible way that you can actually fix the problem by printing money, but they're trying it anyway. They're keeping interest rates at a relatively low level for China's standards, and this is not allowing them to persist in the way that they want to. This is all coming at the same time where we have the trade issues back and forth, but we're hearing nothing but good things coming. Nothing but good on both sides. Everything's going to be fine. Everything's going to be fixed. The trade issues are going to be resolved. Well, some of it is going to take until 2025, I think the number was, but you don't have to worry about that because everything is totally resolved. Make sure the stock market goes up. Make sure the stock market goes up. But it doesn't seem to be having an impact on the actual real economy, which is quite interesting as far as I'm concerned. This is the chart associated with that. Car sales in China are falling on economic slowdown and trade tensions. On the average, this has been falling for several months in a row. Take a look at the global trade, looking at these weekly indicators going back over the last few years, and it tells me that we've got something to worry about. This is from topdowncharts.com, and you're seeing the Baltic Dry Index, which is the blue line, which has looked very terrible. In fact, over the last year or so, it's comparing that to the China Containerized Freight Index. Some of the other indexes as well are in here, just giving us an idea, and you can see the combined one, which is the gray. Essentially, since 2018, this has been falling. And when you see this at a time when we should have maximum prosperity because all of the interest rates globally are very low, lending restrictions are very easy as far as I'm concerned, although they said they've tightened them. If you actually look at it, it's very easy historically. And then you have all of the governments around the world engaging in stimulus programs. Their central banks are doing the same thing. This should be booming. There's no reason why this shouldn't be doing better and better every single month. It should look like 2017. Every single month should look like the months of 2017, but they're not. And now a little bit of extra humor right here. I just wanted to show you this. Percentage of IPOs with negative earnings. I mean, you have to laugh at this. Yes, over the years, it's always gotten bad, but we saw this happen before in the year 2000. As you saw the dot-com boom, the joke, everybody laughs at it, but guess what? It's actually worse today. It's worse today. It's worse definitely than what we saw during the financial crisis timeframe and leading up to it. And of course, every year since, it has been getting progressively worse. All of these different companies that are coming online today, they seem to be these unicorn companies. Okay, we're going to catch the next Amazon, we're going to catch the next, this or that, but it doesn't ever end up being what they say it was. Very, very rarely does it do so. And then you have this. Well, unfortunately, a lot of times people end up getting burned because they're trying to chase that unicorn. Well, unfortunately for these people, they're going to be in big trouble over and over again, but they don't want to let go. They keep on holding on, and unfortunately things happen. Two things really quickly. Mortgage refinance boom goes bust as rates shift higher. Can you believe this? Already this has changed. Mortgage application volume fell 5% last week, and you saw this as a result of interest rate going up from 4.36 to 4.4%. That's it. And already it had an impact. Yes, the impact is small, but in 1 week, that makes a big difference. So we'll see what happens with that. Lyft shares drop more than 10% to new low as experts question its valuation ahead of Uber's debut. Was this a pump and dump? I don't know. You tell me. I already did a video about it. Won't get into anything more. For this video, I'm done. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you are supporting me. You're supporting the channel. I do appreciate that. So hit that like button. Thank you very much. If you want the financial education you weren't taught in school, these two books have everything you need. All the details, all the data at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to know about the 7 million Americans that haven't paid their car bills, all the details related to that, click on this video and I will see you there.